Today we're going to talk about non-farm payrolls and major news and how I trade them. Stay tuned, traders. We'll be right back. G'day traders, I'm Stacey Burke from Stacey Burke Trading. End of the week, non-farm payrolls tonight. Major news last night on the euro, and the economic calendar can be a source of opportunity for us as traders. And today I'm just going to go over our basic system again. We're going to review some trade setups from yesterday. We're also going to review some of the trade setups that happened on the euro and how those same setups can be used on any instrument when major news is on the calendar. Now, just to go over, major news can be an opportunity for the smart money, for the market makers, the banks, whatever we want to call them, to again consolidate volume and then use the news release to either move the market further away from trap volume or hit the stops on both sides, spiking them both orders out, cluster the volume inside, spike both sides, and then resume with their original direction. Typically, what I will do is I will wait for 15 minutes until after the news release is done. Now, a lot of the big news releases happen at 8:30 a.m. New York Eastern Standard Time. Now, obviously, there's varying scheduling depending on where the news is released. If it's in England, it may be earlier in the session. If it's in Europe, it can be at a different time. But a lot of the major U.S. news releases, obviously non-farm payrolls, comes out at 8:30 a.m. New York Eastern Standard Time on the first Friday of every month. Now, often over the course of the day, the market sometimes can offer great trade setups in London prior to getting to the US session, but in a lot of cases, the market can have a bit of a consolidated effect the day before or the day after, or even leading up into payrolls, and that's an opportunity for them to either build up a lot of volume for a bigger geometrical shift where we talk about structure. So often if we get a really tight sideways day going into payrolls, the following week can often be a big week. But if we get a day where they possibly consolidate each session heading into payrolls, we may get an opportunity for a buy low setup back towards the high of the day or a sell high setup back towards the low of the day. But again, I will wait for 15 minutes for that news release to complete, and then again we go through our 12 candle window. So that first hour we will often have the stop hunt, and that is the first thing we want to have happen. Once they've done the stop hunt and their work is done in either direction, we have the opportunity then to assess the pairs, whatever instrument that you're trading, to look for our ideal best playbook trade setup. Now, yesterday on the euro there was some absolutely textbook stop hunts on the news, shift candle, and then a 1, 2, 3 back into the trade where traders would have counter trended that and also traded against the news release, and then the market continued its move for 50 and 100 pips in some of the pairs cases. Some absolutely golden opportunities. I've had some traders send me some screenshots, and again a fantastic opportunity to use the calendar to possibly identify candidates for best playbook trade setups. I talked about this yesterday. I follow mainly the British pound crosses, but whenever you have the opportunity to participate in a trade situation where the odds are skewed, potentially revealing where your edge can be played out, often the news trading prior to the news is 50-50, and I don't like 50-50 odds. I just don't tend to do very well at those. I'm looking for trade setups in our 12 candle window that match my best playbook setups, where they've stop hunted, they've cleared out the book, or they've reversed the market and they're doing a measured move. Opportunities when they're going to move the market, there's very little stress against your trade position. So let's review our simple system. We talk about structure. So again, bigger geometrical patterns, rectangles, head and shoulders, double tops, double bottoms. There was a couple of double tops yesterday or the day before on pound Aussie, pound New Zealand. We talk about descending triangles, geometrical patterns where volume gets built up and we have the opportunity when that pattern goes to completion for possibly a measured move of that geometry. So instead of targeting 50 pips on a trade, we may be targeting 50, 100, or 150 pips. The high of the day and the low of the day. The previous day's high and low, and also the session highs and lows. So we talked about identifying trades that are in profit. So if London has a move and it moves 50 pips from away, it hits the stops, moves 50 pips over that 3-hour window, you think you've missed the trade, but that's where we want to talk about, you know, the average stop hunt is typically 25 to 50 pips. Now that stop hunt can be a trade. So if you've not participated in the original trade and it goes 25 to 50 pips and goes into consolidation, you may be able to participate in a move that's coming back to get the trader that's in profit. Now this is really important to understand. You're not just blindly jumping in and counter trending every 50 pip move, but it's important to understand that when the market goes into consolidation, that they will be coming back at some point to get somebody who's in profit. Now we're not talking about trending days. There's a big difference between a stop hunt, consolidation, and a reversal versus a market that's trending and making new highs or lows, going sideways and continuing that move. And always in day will very rarely ever come back, and it traps people counter trending and it smashes them, and a lot of people will blow their accounts up doing that. I've done that, so I'm going to tell you right now, study the charts. This is really important. You need to print off your charts when you see a great trade setup that you've seen before, and you're starting to recognize the same patterns showing up over and over for buying low, for selling high, and for trend trading, especially in that 12 candle window. Round numbers. The majority of this market movement, regardless of the instrument that you're trading, will be trading from round numbers. Doesn't mean it's going to stop right at the number and go back and forth, but the highs and lows will typically be trading off of those numbers. They hit the stops, they consolidate, and they may continue the move, or they hit the stops, reverse, consolidate at the numbers, and shift the market after they've trapped volume or they've hit the stops and done their work to go back to the other side and either continue a move or hit stops on the other side. We talk about, again, just reiterating the basics, the three things that markets do. They break out and they trend, they break out and they reverse and go to the other side, and they break out and come back inside and just stay in a trading range or a range-bound market. We want to see price confirmation, and we talked about this again yesterday. Engulfments, pin hammers, consolidation, pins, and engulfments with a hammer or a pin with a tail and a hammer after the stop hunt. So if you're not sure what these are, again, identify the 12 candle window, mark off your highs and lows. That is where you're looking for them to clean the board off and then either come back against the trend or consolidate and position for a reversal in that market. So you should typically have 30 to 50 pips minimum between highs and lows. Now we saw some great examples of 1, 2, 3 setups yesterday on a lot of the euro pairs after the news release. So 15 minutes, they went from bottom to top, clearing out all the trap volume that had followed the trend down during the session just prior to the news release. They moved the market, cleared the stops, and then they came back 1, 2, 3, 45 minutes in that first hour of the 12 candle window. Risk versus profit. Okay, so I've heard traders say they don't care about risk reward. I disagree entirely, and because I'm not convinced that you're going to have a 90% hit rate. But I am convinced that if you have asymmetrical risk reward, that you can hit your trades comfortably knowing that you're managing your downside and that your average winner is going to be 2, 3, 4, 5 times your risk on a trade. And managing that trade, 1 bar stop, 50 pip target, there's going to be a lot of trades that go more than 50 pips, but I keep emphasizing just master the process and master taking 50 pips out of the market. If it's 40 and it consolidates, take 40. But really focus on risk control and getting paid. You get paid for performance. So if you're taking 40 pips out instead of 50, but you're doing it 3, 4 times a week, perfect. Monitor your winning trades. How could you have gotten more out of the winner? Could you have taken it for 50? Did it go 75? Was there a way for you to squeeze more out of that winning trade? That's what will come over time as you optimize your performance. Not so much your trading setup, but you're optimizing your ability to perform and take more out of winning trades. So managing yourself and managing the trade, we talked about this again yesterday. I think it's really critical that you have such a simple method so that you're not caught up into the moment all the time, you're not distracted, you're not fearful, hopeful, greedy, all the things that will interfere with you being able to come back at the beginning of a session or just prior to the beginning of a session, looking at your pairs, again, maybe looking at a few different markets to see if there's a playbook, a best playbook trade setting up rather than being really tunnel visioned on one or two pairs and missing a great opportunity where there's an easy trade to participate in a very low stress situation. So what are those? Well, if you're not sure, you should go back and look at the charts and look at the pairs that move 50 pips without any problems. How did that market set up? How could you have identified that? Was there a certain aspects of that trade setup that would have keyed you into that? Was it a tight consolidation? Did the timings, had they already had a stop hunt pre-market? Little things that will tune you in to be able to filter out 6, 12, 18 pairs in a matter of 10 minutes and say these three or four are the ideal candidates, and this is what I'm looking for out of one of the best one or two. So keep it simple. And if you're trying to trade every move in one pair or two pairs, what's going to happen is you're going to get beat up. You're going to have low quality setups on certain days. You're going to try and trade them. It's going to be stressful. You're going to take losses. Your results will be very inconsistent. So it's important to make your trading as stress-free as you can. So talking about the news, I know traders like to trade the news, and they talk about trading non-farm payrolls and all that. I don't do that. I think that there are certain setups that after the fact you can go back and say, yes, I could have traded that prior to the news because they'd already set it up textbook perfect. But at the same time, I've seen trades where they will gap it. You might have a 15 pip stop and the first fill is a minimum of 50 pips away on a major news release. What that means is that they gap it 50 pips, knowingly they've got trap volume and they shift it away. I've been in trades where it's been filled at 50 pips for profit and been stopped out for 50 pips for a loss, 35 pips more than what you expected. So it's a 50-50 situation. Now there's going to be people that disagree with me. That's okay. It doesn't matter. I don't trade in front of major news. I'm quite content, and I've observed this over the last few years. If you wait for the major news release, especially when it's inside of that 12 candle window, or if you use the major news release as the first part of your 12 candle window, it's an opportunity for you to then go after they've either hit stops or had a catalyst for a movement to then look for the stop hunt back and a proper trade setup to enter the market. There was some absolutely perfect setups on the euro after the news yesterday. They did a 1, 2, 3 back into the trend and then continued the move with very little stress for traders that were positioned in the market. So let's just review this. The other thing to consider is that after a major news release, we may get a second day trade set up. Now today we have payrolls. Yesterday there was the year financing rate. Some of those pairs today may be a bit more volatile and not follow through. It is a Friday, it's the weekend. We've had some huge moves on the daily charts on the major pairs. We could have a textbook situation today where we get some second day trades for follow through, again for ideal textbook setups. But not to say that's going to happen, but after a major news release day, you might want to pay attention if we've had a trending day for a second day trade to participate in a measured move of that opportunity. Again, just looking for the simple textbook setups, working from the high of the day and the low of the day. So I wait 15 minutes till after the news is complete. Payrolls, for example, they might spike out both sides. It may be non-eventful, but then we can go back into our 12 candle window, especially if they've done a stop hunt. We want to see if there's a trap, and we want to see if there's a trade setup for a movement of 50 pips or more. So coming back, you can look at the major news releases on any calendar, Forex Factory, Daily FX, doesn't matter, but they'll typically have red news. I only look at the red news. Major news can be an opportunity for them to, on any news release, to hit stops or to shift the market, and that's important to understand. They can use it to pull away from trap volume. If you're already in a trade, it may be the catalyst to complete the move, but it can also be an opportunity to hit stops on both sides and then go back into consolidation in the trend of the original direction they want to move it in. So just to reiterate, our windows: Asia 8 to 11 p.m., London 2 to 5 a.m., New York 8 to 11 a.m. Now I just want to review talking about the stop hunts. So usually at the beginning of each session, the market will hit the stops. Now we can see a stop hunt prior to the session 12 candle window, as we've seen in the London US changeover. Often we will see a stop hunt prior to the 12 candle window where they've hit the high or hit the low. Now I want to reinforce the average stop hunt will be 25 to 50 pips. Anytime the market moves 50 pips, look at how it behaves. Now we're not talking about days where the market's trending. We're talking about where it's been in consolidation. It comes out of this consolidation in our 12 candle window. You may have been in a 50 pip move down or up. It goes into consolidation 50 pips away from where that range started. That's important because we will often see opportunities just at the end or in that first hour rollover of that extension of the 12 candle window. 3 pushes down, 50 pips. They'll come back to get traders who are in profit up here. And what's important about this, if you haven't even participated in that move, is to know what's happening heading into the US session. I had a great question. Somebody asked me to talk about a mirror image trade or a measured move. What that is when the market moves 25 to 50 pips and comes back and stop hunts a trader and goes through that range, we will often see the same move occur in the opposite direction. They have trap volume now on the other side, and they will do a mirror image of that trade setup in the other direction. So this may be a counter trend stop hunt or a blow off to complete a major trend movement. They stop hunt back up, they go into consolidation. The stop hunt then in the next 12 candle window in the US will typically be against the trend this way, and then the trade goes back in the other direction, the same distance. So you'll often see me make notes on some of the screenshots, measured move. So if this is 50 pips from below the Asian range, we expect to see 50 pips above the Asian range for a measured move target, and it will often exceed that in a lot of the cases. So again, high and low of the day, we're looking for the stop hunt. Say the market just comes out and blows off, that is the stop hunt. If it's a trend trade, what we will see is the market will break out, pull back, and continue its move. We see traders trying to counter trend this when it's a breakout pullback for a trend trade, and that's important. Print off your charts, look at trending days, look at stop hunt days. Stop hunts will typically move right down, or they'll have 3 pushes down the 25 to 50 pips. A breakout will come back with 2 to 3 pushes and continue the move, with trap traders trying to counter trend that. They'll counter trend a trending day all day long. They'll pull their hair out, they'll be taking loss after loss to finally where they decide to go with the trend, and that's the end of the move, and the market pulls back into consolidation and stays sideways into the close. So keep it simple, traders. Know exactly what you're looking for. Timings, 12 candle window, 25 to 50 pips. If you're not already in the move, 25 to 50 pips is the average stop hunt. What does a stop hunt look like? Typically a stop hunt will either be straight vertical 1 candle and a consolidation, or it will be that second hour is really important. The first hour could be a stop hunt inside. The second hour can be the move back in the other direction. And the third hour can be the completion of that 50 pip move. So we talked about the hourly rotation. Just keep thinking at the end of each hour, if they've done a stop hunt from the low of the day, the trend's been down. If they've done a stop hunt from the low of the day that ends at the high of the day at the end of the first hour, and you get an inside bar, an engulfment, a pin hammer, and it's the beginning of the second hour, you can trade that in the other direction. Now also, if we get to the end of the second hour and we've taken out the lows, that market should either continue or it will go sideways, and again we'll have an engulfment or something coming back against the trade. The important thing is, traders, to look at just identifying the best trade setups for buying low, selling high, and trend trades, and then just keep it simple, really simple. Don't worry about trying to trade every move. If you're looking at a pair and it moves and you go back and look at it later and you saw that it moved and you're kicking yourself because you think you should have traded that, if it's not really easy for you to step back and identify, a textbook playbook setup, then don't worry about it. We're not trying to trade every move. When you're going into 50-50 situations and you're not sure, you're more likely to make some errors. You're more likely to have mistakes on those types of trades that will end up costing you psychological capital and financial capital. So keep it simple, keep getting better. We're going to look at some screenshots from yesterday as well as some major news releases from other payrolls sessions, and just keep it simple. Have a great trading session, end the week on a strong note, and may the markets go with you.
G'day traders, Stacey Burke from Stacey Burke Trading. Just continuing our discussion on non-farm payrolls and major news releases. And yesterday we had the European main refinancing rate, and there's some great examples of how the news can set up a great setup opportunity for the 12 candle window. And the Europe financing rate came out at 7:45 a.m. New York Eastern Standard Time. And looking at the euro, we can see that heading out of the Asian session, they extended the lows before pulling back just prior to the 12 candle Europe-London window and dropping it down to the quarter level at the numbers and consolidating sideways heading into the news. So we're not trading the news, but again, just as we always do, we just redraw our highs and lows. We have the high of the day, the low of the day. We redraw them, the previous day's high, obviously, the blue line. And then the higher highs from the Asian session. We can see that the news blew through all the stops. And we wait till after the news. And then in our 12 candle window, we see a 1, 2, 3, and then a reversal with a 2-bar reversal, then the pin hammer. Now, traders, if you're not sure where to get in, print your charts off and pay attention to this. We have a 2-bar consolidation after a 1, 2, 3, and then a breakout candle. So some traders would have traded the break of the bear candle high. Some traders would trade the break of the bull candle high. Some traders would get in on the close of the bull hammer. Some traders would get in at the numbers. Some traders would see the breakout and then fight for a better fill at the numbers. Again, when you see the 1, 2, 3 and the reversal, you can position yourself in the market. You can use a 1-bar stop. You can use a stop below the 1, 2, 3. You can use a stop 25 pips from the numbers if you're filled at the numbers. It's whatever you're able to finesse, and you have to make those decisions in live time. But that's why it's important to come to the screen prepared, knowing that you can possibly see this type of setup after they've done the stop hunt on the news release. That market continued its move and extended the range for a 100 pip move up. And now we've gone sideways into consolidation. Looking at the the euro yen. These are the euro pairs. Again, each day we've got our blue line, the previous high of the day. We're looking at structure. So we redraw our highs and lows. They extend the Asian range. We project that line across. The market moves up and stop hunts lower level shorts. Before we head into our Europe 12 candle window, we redraw our high and low when the market moves down. It extends the Asian range, pushing down lower, and then a 1, 2, 3 reversal engulfment on the news. And again, you'll notice we have a 1, 2, 3 blow off stop hunt to the low, pulling back in our 12 candle window. So stop hunt to the downside, hit the stops up top, 1, 2, 3 down, inside bar. And again, here's an opportunity. Traders after the 1, 2, 3 may position themselves at numbers. They didn't get filled down at the double zeros, but they may have traded the break of the inside bar. They may have traded the break of the quarter level. The market goes sideways into consolidation, and the 3 pins trap traders into thinking this market is going to come back down for a measured move, and they short the market, and then they get the consolidation inside bar bull candle. The market again breaks out and breaks through the highs. So every time you see a high and a low and they cluster it inside, you have to be paying attention. But we had the stop hunt high, we had the stop hunt back down. So some traders would have chased the move long on the close of the announcement candle. They come back down to get them. Traders short the market thinking this market's going to continue through the bottom for a measured move. They consolidate it inside bar, they pull it back sideways again on top of the original Europe session high. So they consolidate it, they break out to the upside. Another opportunity for traders to if this is a market in a fast moving market, if these trades are going to go, they do not come back. Now again, I'm not saying that you would trade every move, but we're just talking about using the highs and lows in the 12 candle window, understanding the stop hunt, and the traps that they set with people chasing the momentum before they consolidate it, and then they move with the original direction they intended to move the market. EuroCAD, another example. We redraw our highs and lows each day, high of the day, low of the day. You can see where the market went sideways in Asia, dropping down, hitting stops, pulling back, extending the range before consolidating at the Europe Open and then moving down just outside of the 25 pip box before we had a 1, 2, 3 down, and then we had a 1, 2, 3 back inside of the range. They stayed sideways inside of the 25 pip box, 1, 2, 3 engulfment just prior to the news. So again, we talk about setups that are conducive just prior to the news. Now, I don't trade these, but again, you can see the engulfment after the consolidation, and they've hit stops on the 1, 2, 3 reversal just prior to the news. So they've worked the bottom of the day, they've hit stops, consolidated it, given an engulfment with hammer just prior to the news. The market breaks out, pulls back, goes into consolidation, and then continues the move. Now, these are trades where the market is moving quite quickly and people feel like they're chasing the move and they're not sure if this 1-2 is going to be a reversal, all these situations. So again, we're looking for opportunities where the market has already cleared the stops, had the news, we're inside of our 12 candle window, so we've seen the micro double bottom trade setup happen at the low of the day prior to the news. The market breaks out, pulls back, but we have a 1, 2, 3 sideways and an engulfment long back with the original trade direction. And this is an example of where we talk about measured moves. So taking a projection of that first leg or the breakout of the rectangle. So we can go back and we look at our bigger geometrical structure. We're inside of a rectangle in that 75 pip box from high to low. So the market obviously is broken out of this box, but the box itself is 325 pip boxes, and the measured move on that can be 150 pips. Now, traders following the news may have just trailed this all the way up or taken their 50 pips or taken it for 100, whatever they wanted. We may see this market continue again. That will be decided as we head into the Asian and Europe sessions. Point I'm just trying to make is we redraw our highs and lows. We wait for the market to do its work. So cleared the board, consolidated, hit the stops again, cleared the board up top, consolidated it, and then continued the move. Okay, we're looking at non-farm payrolls from May 8th on the pound Swiss. Just reiterating our simple approach. We want to redraw our highs and lows each day. First thing we notice is that we're inside of the previous day's trading range. We have blue line from the previous day's highs and lows. As the session unfolds, we just follow our process. Market makes a swing low in Asia. We draw our lines. We come into our 12 candle window in Europe, and the market hits the stops and reverses. Doesn't quite get to the high of the day before consolidating and then dropping down towards the low of the day. We get a pullback and then the payrolls. So we talked about how payrolls can often be used to hit stops on both sides and waiting for that news to complete. We're in our 12 candle window. They've done a stop hunt. We're at the bottom of the day. The market goes sideways, and then we get our engulfment candle. And just at the U.S. Open for the equities market, and then the move back to the high of the day. So again, just using our high and low and our measuring tool. People have asked, Fibonacci, whatever, it doesn't matter. It's just a range expansion, but you can see that targeting the numbers in this particular case, exiting the market didn't quite follow through. You have an inside bar. You can get out at the numbers. But that market moved 50 pips. Looking at the pound yen, again, just to reiterate, we're not talking about hindsight trading. We're just talking about process. We're talking about process. We draw our highs and lows. And each session, we wait for the market to hit stops and give us an engulfment or pin hammer off the low or off the high. We see the market consolidated sideways in a range in Europe. Eventually they come back down and they hit the bottom. They hit it again. Little pin hammer reversal prior to our 12 candle window. We go 1, 2, 3 sideways. Payrolls hits the stops on the top. Pins traders who are long on the bottom. So we wait for the news. Market goes sideways. 1, 2, 3. Pin hammer and reversal engulfment and a breakout candle. Now traders may have positioned themselves on the breakout candle after the 1, 2, 3 reversal. They may have positioned themselves in the breakout candle, chasing the move. But either way, the market has come out and moved 50 pips from the high of the day before it's gone into consolidation. So traders who possibly entered in late may not have got their 50, but once this market has moved 50 pips, it pulls back and goes into consolidation. So we talked about this, about paying attention to when a market moves 25 to 50 pips away from the original Asian range. And again, there's an example of if you're in the trade, you want to be paying attention after a 50 pip move to either tightening up your stop and trailing that, or consolidating and exiting the trade, or being aware that that market may now be at the end of its move. And just looking at the British pound, again on the non-farm payrolls on May 8th, just redrawing our highs and lows as the day unfolds. We have Asian high, and we head into the Europe session. We have a swing low in Asia. The market hits the stops, pulls back into consolidation, hits the stops again from the Europe low, pulls back in our 12 candle US window. 1, 2, 3 hitting the highs of the Europe London Open, and then one vertical candle on payrolls, ending the move, or hitting the stops and then hitting the stops. So you can see again the news. They hit the stops on both sides. The market went into consolidation just prior to the US Open, and then reversed with an engulfment and then a little bull candle at the numbers for a breakout trade. So again, traders may have traded the reversal engulfment after hitting the stops on the bottom. Traders might have been chasing this, thinking it's going to continue for a measured move. They reverse it. A little sideways bull candle, and then a 75 pip move up through the highs of the day. So a point I'm making is the stops were hit. Stops were hit on the news. They consolidated it. Reversal. Traders can position themselves on the engulfment, the numbers, or the breakout candle. Now, once this reversal's happened, I would look to position yourself in this area as best possible with a 1-bar stop. If you position yourself in the breakout, you definitely have to have a 1-bar stop, because if this breakout is wrong, it will reverse immediately. And if your stop is down here, your risk increases, obviously. But if you have a 1-bar stop, the thesis behind a strong move is that it should never come back. This should move quickly through the other side. And again, this breakout trader would have gotten 50 pips also. So, but again, just reiterating the basics, high and low, high and low. The market was moving lower, trapping volume short before shifting the market quickly and aggressively, moving through the stops and shifting the market. Trap traders hit the stops, shift the market, and move aggressively in the opposite direction. So hopefully you got some value from today's video, traders. Stick to the high and low. Wait for the smart money to show their hand. I wait till after the news is out, because there'll always be an opportunity after they've done their work, whether they've cleared boards and hit stops, or they're shifting the market and moving aggressively for a trend trade. Let them show their hand first. The trades prior to the news or in the news can often be a 50-50 opportunity. Try to skew the odds more in our favor. Trade with your edge. Keep it simple, traders. Keep getting better. Have a great weekend, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at StaceyBurkeTrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.